582 trillion US dollars are the bond market, the equity market, and the money market combined. And Strategy plus Strive, those two companies, are currently the only ones that are going after that huge amount of money in a serious way with Bitcoin. Bitcoin is the only asset that you can use as a base if you want to build financial products on top to capture hundreds of trillions of US dollars in market capitalization. And that's why I sat down today with Joe Burnett, the Vice President of Bitcoin Strategy at Strive. We talked in detail about Strategy, Strive, the digital credit ecosystem, and the Trojan horse that is coming towards the fiat system. Enjoy. Overall, 2026, how has digital credit and Bitcoin treasury companies have been involved for you?
Well, I guess one, thanks for having me on the show. Appreciate it. Glad to be back. A lot of different topics to talk about there. And like the evolution of Bitcoin treasury companies has been interesting. So, I mean, like for those that don't necessarily know me, I worked for another number of Bitcoin companies. I joined Similar Scientific, which was the second US publicly traded company to adopt a Bitcoin treasury strategy. I joined them last year. And then into that role, we were acquired by Strive. And so now I'm VP of Bitcoin strategy at Strive. And we have a very similar goal to Strategy, or Michael Saylor's company, as many people are familiar, where we try to construct an intelligent, amplified Bitcoin position via preferred equity, perpetual preferred equity securities, to where we think if you expect the CAGR of Bitcoin to be 20%, 30%, 40% or higher over the coming 5 to 10 years, which we do, then borrowing or accessing capital at 13% is a rational trade, especially if that capital is in the form of perpetual preferred equity where it never comes due and there's no liquidation risk, there's no margin call risk. And so we're able to construct this amplified Bitcoin position, which by definition is amplified, meaning if Bitcoin goes down, our stock would go down further. If Bitcoin goes up, our stock would, adjusting for the cost of capital, go up, more than that as well. And so like that's the general thesis: construct this intelligent, as low risk possible amplified Bitcoin position as we can, and issue this digital credit security, SATA, which is how we construct the amplified Bitcoin position, and help people that want a moderate duration instrument or an income investor that just wants yield, help them bring capital into Bitcoin and offer them that different volatility profile, income profile, that's effectively still powered by Bitcoin at the end of the day. So that's kind of, a very high level of, what we're doing at Strive.
I love that. And it's actually, I've dismissed Strategy for like years. I had Seyr on my podcast even 2024, and I haven't invested in Strategy until December 2025. So it took me 1.5 years later to finally get his company. And it was for digital credit, because I found that idea so intriguing, because it's very, very clear for me that Bitcoin will go up by at least 20% the next 10 years. Some say higher, some say a little lower. Everyone has this different model. I think 20% is conservative. Maybe it's not, maybe it is. But even if it's just 19 or 18%, the ability to raise capital, and so much capital, is just mind-blowing. And when I saw, especially in the early 2026, how much capital Strategy is able to raise in a bear market, was quite astonishing for me, and made me really rethink of the role of Bitcoin treasury companies. Now Strive is doing something very interesting, because they are smaller and more nimbler, if you can say it like that. They can do things maybe a little bit quicker. The daily dividend that came out was really interesting and really cool to see, and very impressive, honestly, how quick this was coming into life. How do you see the digital credit, how it currently is looking like? Because it looked really good in the beginning of 2006. Then we went through this short crash where I think Stretch was down to like 70 something, 72, 75. Seyr was always a little higher. Now I think it's back up to, I don't know, 80, 90, something like that, Stretch. And I think Seyr is almost at 100, 97, 96, if I have the numbers correctly. It depends on the day when this comes out also. How was the journey? How did you see the journey from those products, from the low point to back to par, even though it's not yet hit the par point? And how meaningful is that also for as a learning for Strive and strategy, maybe, of what they can like take away from all of that?
Yeah, absolutely. I mean, first, like taking a step back, like thinking about digital credit, Stretch STRC didn't launch, I believe, until July of last year. So it's basically, it's coming up, or it's arriving at its like 1 year, 12-month anniversary. And obviously these securities are very unique and different from anything really people are actually familiar with, right? There's a lot of like new novel concepts within it. Probably the major like unique concept, I would say, is the fact that most people lend money in all sorts of different credit instruments to corporations or governments, and they typically expect the corporation or government to obtain money at some point in the future, typically via like having a profitable business, right? Like, for example, if you buy Walmart or Apple or Microsoft, like corporate bonds. Well, Microsoft, all these companies have like large businesses, lots of people, factories, and whatnot that are producing things, and they don't have necessarily the money on hand today, but they expect to do all these things in the future, and they hope 5 to 10 years from now they're still doing all these things and they're making the money that they can eventually repay you back. Whereas this is like a completely different concept, in the sense that Michael Saylor says this pretty nicely, where he says, you're lending us the money, but we already have the money. Most companies, you lend them the money because they don't have the money. For Strategy and Strive, we already have the money on our balance sheet. We have decades worth of Bitcoin, decades worth of dividend obligations in the form of Bitcoin, form of money, a good form of money that we can use to honor the dividend obligations over time. So it's a completely like unique, different model that I think from the outside, as people are learning about these instruments, only 1 year or less than 1 year in the case of Seyr, is a completely new concept that I think probably appears to be extremely risky and unsustainable at first, because again, like there's not necessarily like a recurring cash flow thing underneath a Bitcoin balance sheet. But at the end of the day, that's not really the model. There's arguably a lot more risk trying to generate operating cash flow 5 to 10 years from now in the future, due to AI risk, regulation risk, so on and so forth, rather than holding just a simply scarce asset that, just like gold, logically should appreciate in terms of dollars over time, and using that asset as just part of your balance sheet to access capital to honor the dividends over time. And again, like we already, these companies already have the money to pay it out. So I think part of the drawdown that we saw in digital credit was investors just starting to learn about like what are these instruments, like why is it working, why are you look at most dividend stocks, or you look at corporate bonds or T-bills and whatnot. It's like the yield on these instruments is low, certainly compared to digital credit, STRC and Seyr. It's like, why is that? Well, one, people Strive and strategy are raising a lot of money. So like, they're trying to meet the market where it's at and paying this, relatively high rate, and they're raising a lot of capital by doing so. And that's just kind of like where the market is at right now. And I think part of the drawdown was it grew really fast, really rapidly. We learned that, it seems like strategy has learned that having the USD reserve was like a very, important step to maintaining trust in their credit product. They used a lot of the cash on their balance sheet at one point to pay off one of their convertible notes, which they're trying to do that for good reasons. But it turns out that maybe investors didn't prefer that. Maybe investors would have preferred just holding the cash to make it super clear that they were going to honor the dividend obligations for the foreseeable future. And then the other thing was they traded very closely to $100 per share, if not like perfectly steady at $100 per share, which invited retail and crypto speculators to go out and use those assets as collateral, borrow against it, buy more of that asset, which again enabled both issuers to issue more of it. And then all of a sudden, because there are now leveraged positions in those instruments, there's now automatically forced sellers at certain prices if the price falls far enough. And so, someone could short it, or there could just be weakness in the market. And if the price starts moving down, it could cause a reflexive leverage-based, kind of feedback loop where there are forced sellers all the way down. So I think that played a role, but I don't think that necessarily impacts like the long-term sustainability of this concept. I think like one way that I really like to think about these instruments is if you, and Seyr has talked about this metric like a good bit, but he calls it the Bitcoin ARR or Bitcoin CAGR required to offset 100% of the dividend obligation. So the dividend obligations may be, or the dividend yield on the instruments may be 12 or 13%, but the required Bitcoin CAGR, how much Bitcoin needs to go up per year, doesn't actually need to be 12 or 13% to offset all of the dividends that need to be paid for each year. In the case of strategy, it's like 3 to 4%. In the case of Strive, it may be around 7% right now. And so I think that's a pretty big deal, because if you start to think about like, what does the average person think about Bitcoin? They probably don't expect Bitcoin to go up 20, 30% per year like we do. But they probably expect it to go up over time, because everything goes up over time. It's not like that crazy to think that Bitcoin, a perfectly scarce form of money, could go up over time. So yeah, I mean, that's a long-winded answer, I guess, to say that there was obviously some, real volatility in the space, but I think like the long-term outlook for the sustainability of digital credit is extremely bright.
I want to bring up a chart that I couldn't find in the internet, so I just made it myself, and I hope it's roughly okay, right. So I'll just keep that as a disclaimer out there. I just made it up with the thing that strategy put out there. That's the Bitcoin that they acquired per year. Again, that maybe the number's a little bit off, but hopefully they're as correct as I can put them together with Claude. And this is one thing that made me really turn me more bullish on strategy than before. And I hinted at that before. We have those price cycles, and obviously if the Bitcoin price goes up massively, there's a lot of excitement in the market, which also drives up the multiple of amplified Bitcoin, and then they can raise more money with the common shares. Now, if the market does the opposite and Bitcoin price goes down, the multiple goes down also for the common shares. Now they're not as efficient in getting more Bitcoin. And you saw that with 2020, 2021, and 2022. 2022, they were not really able to raise a lot of Bitcoin. I mean, 8,000 is still a big chunk of Bitcoin, but when you compare it to what they raised in 2024, when the market was good, 2025, and the market was at the all-time high, it's not even comparable. Now 2026, you can argue it was not a good good year for Bitcoin so far. We've gone down. I think we started the year around the 100K area, maybe 95K, something like that, and now we had like 60K, 65K, like whatever the daily price is. And just at the 6-7 months, I think we're at 7 months of the year, we've been already raising 170,000 Bitcoin, which is, if you just make that up for the full year, in case if you assume they are as successful in the next months than they were in the previous months, that would be the record year. And even if it doesn't happen, it's a massive success in itself. Even if they don't acquire a single more Bitcoin, that year being such a drawdown year, the MNAV being so contracted compared to the previous years, that in itself is already, I think, a massive success for the common shares. How do you is that the reason why digital credit is so much better as a vehicle to raise money compared to the convertible notes, as you also said in the beginning? Because a lot of people, they see, okay, they raise money with convertible notes, they paid like 0 point whatever percent or almost nothing, and now they're paying 13%, or like in Strategy's case 12% yield on that. That seems like, if you are not deep into capital markets, it seems like hard to understand why they're doing that. And this chart has been the easiest for me to explain it to other people, why it's such a good strategy to pay more in order to raise more capital.
Yeah, no, I think that was very well said. And I love this chart actually, because it does reveal that in the past, Strategy is primarily only raised a lot of capital in the bull markets relative to their current Bitcoin stack. But this was kind of the first time that they were actually able to raise a lot of capital in a bear market. And yeah, I mean, there are a number of reasons, obviously, why they have began moving from convertible debt to perpetual preferred equity. I mean, like, one is simply like the duration mismatch. Like, convertible debt is decent in the sense that you can issue convertible debt that might mature in 5, 6, 7 years. But Bitcoin being this long duration asset, like really extremely long duration asset, you kind of want like the longest duration liability or obligation that you can issue to be paired with Bitcoin. You very clearly don't want to pair this very short duration like margin debt with Bitcoin, because Bitcoin is so volatile, you'll get wiped out. And so even if Bitcoin goes up over the long run, you might be forced to sell your Bitcoin smaller. And then the convertible debt market in particular, they kind of maxed it out. Like, I believe they were like one of maybe the last year that they were like really doing it at full speed. They may have been the largest issuer of convertible debt, kind of like in global markets. So like they'd kind of ran out of space there. And the preferred equity market is interesting, right? Because it can be publicly traded. It's listed on a ticker. Anyone can access it. It's very liquid, has a lot of volume, and like right now, I believe Stretch STRC is like the largest preferred equity ticker in the world right now, which is interesting, and largest by volume, largest by market cap or AUM, or notional value outstanding. And I think that's like a really interesting thing, because it's like, okay, well, did they already like tap out the preferred equity market? And because they're the largest issuer of preferred equity, pretty much. My answer to that would be no. Like, I think like this is such a big idea in the grand scheme of things. It's just like Strategy has just kind of been on a mission of, one, how can they best construct this amplified Bitcoin position? And then two, how can they do so in a way that's like compliant, in a way that works within existing capital markets, And it just so happened to be preferred equity, and the way that that works, and the way that that can be issued, and the way that that's very accessible to a wide variety of investors. That's just like the best way to issue this type of instrument. And so to think that like just STRC and SEDA, like they're kind of like reinventing the entire preferred equity market. Like they're just putting this high yield Bitcoin powered credit instrument into the market via this unique structure that has existed for many years. And it's a game changer, because again, if you like look at the actual yield that's offered by Stretch, for instance, and you compare that to historical S&P 500 returns, historical bond yield returns, historical other preferred equity returns, historical real estate returns, it's arguably like superior than all of them. And so it makes it like super clear that like this is an interesting instrument that clearly, as your chart pointed out, like is capable of raising a lot of capital, billions and billions of dollars of capital. And unlike other ways that, or investment products that people might come out with, this is like incredibly scalable, because it's creating new dollar credit and buying absolutely scarce Bitcoin. How much dollar credit do you want to create to buy a perfectly scarce amount of Bitcoin? I mean, you want to create billions of dollars of dollar credit, or trillions of dollars of dollar credit. And I think like that's definitely possible when you compare the potential return, that the risk adjusted return that you could receive with digital credit compared to all of the other investment opportunities out there. I think once you like begin to understand it, and once you understand like that Bitcoin CAGR that's required to offset the 100% of the dividend obligations to make that actually sustainable, it starts to become like, wow, why is, it starts to make sense why $10+ billion of capital flew into this. And it starts to also, open up the possibility that, well, maybe 100 billion, maybe a trillion could flow into this if it's superior, actually, better. And as Bitcoin goes up, the collateral ratio goes up, the BTC rating goes up, and it enables more issuance of this. So yeah, I mean, it's super interesting times, and it's quite exciting, I would say.
I ask myself often this question of like, what are the biggest pools of capital that Stretch and SEDA can actually tackle? Because it seems like it's something that could be interesting for retirees. It could be interesting for just like income investors in general. It could tackle the bond market. It could tackle even company balance sheets if they have capital, working capital that they need in 12 months, but not next month. It could be an interesting place for them to put it and get a 12%, 13% yield instead of 4% or something like that, or nothing, depending on where they are. What is the most attractive pool of capital for digital credit?
Yeah, I mean, I kind of like you said, I think it ultimately competes with everything. Matt Cole, who's like large institutional investor at CalPERS, managed like many billions of dollars. He always talks about the concept that institutions require a track record before they are able to allocate to any sort of like new instrument, which is obviously the case with Stretch and SEDA. So institutional investment as a percentage of the total notional outstanding is low compared to retail investors. Just like Bitcoin, in the early days and even now, institutional investment is low compared to retail. It's kind of like a decentralized bottoms up movement, because both are completely new, novel ideas that have never really existed before. And institutions, like by design, move very slow. There's like committees. Again, they require track records. They have certain institutional mandates on what they can and cannot touch, and rules around what they can and cannot touch. Whereas individuals, can do crazy things, but at the end of the day, they have a lot more freedom. And that's what enables some people to do, very bad decisions, and some people to make great home run decisions, like buying Bitcoin in the early days. And so I think at the end of the day, it's coming after it's coming after everything. I mean, I think, like talking about Bitcoin, we mentioned Bitcoin as this like super long duration asset. You need a 4 or 5, 10 plus year time horizon for it to really make sense. And you got to be able to tolerate the very extreme volatility, before the 4 or 5, 10 plus years. And not many people can do that. Most people most people have TikTok brain to some extent. They want something right now. They want 1 day delivery, and they can't think long term, and they need the next dopamine hit. And even like institutional investors and corporations think like that, right? Like they think quarter to quarter. They can't necessarily plan long term. Like they need a good win now, and if you have a big loss in a particular quarter or particular year, like Bitcoin inevitably brings, that's not going to work out for you. Same with a financial advisor. Some like Bitcoin, but if the client doesn't comprehend or understand that you need a 4, 5, 10 plus year time horizon to hold Bitcoin, then the moment there's a bad year in Bitcoin, the client might be like, financial advisor, like, why did you tell me to buy this? This is you just like lost a good chunk of my portfolio over couple years, over a couple quarters or a couple years. And again, like most people don't have that long time horizon. So I think what's so interesting about digital credit is you don't have to have that super long time horizon anymore, especially with like SEDA, this concept of a daily dividend. You get rewarded every single day, every single business day for owning the digital credit instrument. And so it actually like creates unique, different incentives that make it more easy and tangible and lower volatility to realize like, hey, you're getting that reward here, even though Bitcoin will get, like, if it continues functioning and it is what we think it is, and it does what it has done in the past, it will probably do well over 4, 5, 10 plus year period. But even though it's done that, 99.9% of people still don't hold Bitcoin, and they don't have a huge Bitcoin allocation. And part of the reason is because they don't understand it. The volatility is like confused them. The cycles have confused them, even if it does make sense. And so digital credit is kind of like just showing them, hey, this actually does make sense. You can see it makes sense, and as Stretch and SEDA continue building these track records and simply continue paying the dividend at a dividend rate that is vastly superior than almost anything else that you can get on the market, I think it's going to start to really click for a lot of people. And I think that's when a lot of capital is going to really start to flow into these instruments and therefore flow into Bitcoin. And so it's like, what is digital credit competing against? Right now it's it's a lot of retail investors that want to hold this and earn high yield. But at the end of the day, it's competing against anything that is, offering a less superior risk-adjusted return than this. And that might be, a lot of things.
So if I understand it correctly, those products get more attractive the longer they're on the market and the more money is in them, which is like weirdly of like they're getting bigger, and the bigger they get and the more successful they are and the longer they are on the market, the easier it is to make the next step of like raising more money with them and getting even bigger institution and bigger corporates also into that system.
Yeah. I mean, it's, just like anything, you share that something offers a relatively high yield. Most, and smart, intelligent people are going to be like, oh, well, that's obviously too good to be true. Like, how is that possible? There's obviously a lot of unknown risk here. And there's plenty of risk. You can go through any of the potential risk, but I think like on a risk adjusted basis, it might actually like be very, very logical that these things, as long as Bitcoin continues to perform, these things could be around for a very, very long time. And like anything, as Bitcoin remains around for a long time, or as any sort of internet remains around for a long time, or as digital credit yielding 12 to 13% remains around for a long time. Now the question, going back to like the financial advisors, the client's like, all right, your diversified portfolio, earned 9% or 8% this year. Congrats, but these other things are paying 12 and 13%, and they're paying it, as a dividend. Like, why was I not in that? Like, that's what's been working. And if it works for, as of now, for a stretch, 12 months, SETA for like 9 months, as it works for another 9 months or another 12 months, and then a year after that, and a year after that, it starts to become like hard to deny as like, okay, well, why are you not doing this?
I also think it's actually really good that they're going through the stress right now in a bear market. And the reason is, for me, very obvious, but I don't see enough people talk about that. But if they make it through the bear market, and the worse the bear market gets, the better it is actually, they make it through this bear market, they can show how in the early stages they even made it through this bear market, and they will work even better in the bull market. And so having not only a track record of like good Bitcoin years, because then it's easier. If like, let's say Bitcoin just went up and instead of crashing down to 58K, it went just up to 150, 200, 250K. In that environment, it's easy for a financial instrument based on Bitcoin to also work. Like it's easier than in stressful days. And so if digital credit makes it through a very stressful year and still bringing benefit to the digital credit shareholders, but also to the common shareholders, I think it's the best thing that could have happened in that sense, like launching something, getting something ready, and then stress testing in the first year.
Yeah, I mean, absolutely. I mean, the best time to build a track record is through a brutal, tough bear market. I mean, if you think, you look back at like different like financial products or ETFs that you could have bought over the years, I'd want to buy the ETF that came out like right before the global financial crisis, survived that crisis, and still to this day like offers like or has historically generated like relatively good risk adjusted returns. I don't want the one that launched right at the bottom of the financial crisis and claims to have incredibly high returns. I want to see how did it perform through, one of the worst periods of financial history. And I think if Bitcoin can, have a 50% drawdown, you want to know like, well, how would it perform when the underlying balance sheet draws down 50% or the underlying asset on the balance sheet draws down 50%? Well, then we actually have historical evidence of how that works. And if it works pretty well, then, it's like, okay, well, you have to draw up a pretty extreme scenario to outline why this might not work. And at a certain point is like, okay, well, this won't work if Bitcoin goes down 80% and stays there for the next 10 years. Well, it's like, all right, well, yeah, if that happens, you probably should allocate capital to shorting Bitcoin. And most people obviously aren't doing that because they don't think that that's going to happen, or they don't have high conviction that it's going to happen. And if you don't think that that's going to happen, well, maybe even if Bitcoin goes flat for a while or slowly goes up over time, like the 3 to 7% per year, then these digital credit might make a lot of sense.
Yeah, it's so funny. I recently made a strategy video diving a little bit deeper in what I think. And I saw some comments of like, oh, but what happens if Bitcoin crashes? I'm like, yeah, it's amplified Bitcoin. If you amplify something that doesn't work, it works like even more not. So like you have to be when you invest in any amplified product of an underlying asset, you should really believe in this underlying asset, otherwise it wouldn't work. The only thing I would say is you could be someone not believing in Bitcoin and still investing into Stretch. I mean, I don't know if there are a lot of people that currently do that because it's such an early product. So probably most people that have allocated money to Stretch or Seyr have some kind of conviction into Bitcoin. Otherwise, it's probably too early for a lot of like outside capital to do that. But or is it like that? Like, do you think that people that don't believe in Bitcoin still invest in Stretch currently?
Yeah, I would say so. I mean, I think it's a mix. Like, obviously, Seyr has been one of the most outspoken proponents of digital credit and, of course, Bitcoin as well. So there's probably a lot of people within the Bitcoin community that have allocated to digital credit. But I also think that, like for me and a lot of people even like at Strive that are like huge Bitcoin bulls, we either don't own digital credit or we own a small amount of it. And the reason is because we expect Bitcoin's CAGR to be, 20% or 30% or higher over the next 5 to 10 years. And so it's like the investors in digital credit are, you have to believe that Bitcoin isn't going to zero tomorrow, of course, but you don't have to think that Bitcoin is going to go up at 20% per year. And so it's like this subset of investors, I would say, that is actually like a broad majority of investors that may not be like huge Bitcoin bulls, because they're huge Bitcoin bulls. They buy Bitcoin and then they buy amplified Bitcoin, but maybe they're, Bitcoin skeptics or like Bitcoin optimists where they think, yeah, maybe Bitcoin goes up at the rate of monetary debasement. And that's, it's too volatile to like, make an allocation of Bitcoin in that case, because if Bitcoin's going to go up 7% per year, but it's going to be like a 50% volatile asset and occasionally draw down 50%. I mean, I would not want to own Bitcoin itself. But if there's digital credit that becomes sustainable, if Bitcoin can go up 7% per year, and this digital credit instrument yields 13% or 12%, and it's significantly less volatile than Bitcoin, I mean, people are going to allocate to that. So yeah, I think it's still like very early. And I definitely think that there are people that like maybe have Bitcoin in their portfolio, or maybe don't have Bitcoin in their portfolio, but are interested in income investing and they think Bitcoin's not going to zero. And those are kind of the type of people that might be allocating to digital credit.
So you just need to believe that Bitcoin isn't going to zero, which I think is more and more common. Like I meet people that don't like Bitcoin, but they kind of accept it's there and it won't go away anytime soon. And there's like, of course, the what is it called? Lindy effect. Is it the Lindy effect? Whereas like if it's there for 17 years, it's likely to be there for another 17 years. But the actual question I wanted to ask you before is, do you think that because it attracts so much capital and the pools of capital just get bigger, the bigger Stretch and Seyr and also Strategy and Strive it has the effect of almost like a black hole or like a Trojan horse or whatever you want to use as a metaphor for the TradFi world to actually adopt Bitcoin, of like they see a product like Stretch, they have to get it on the balance sheet, maybe not now, but like in 5 years when it has track record. Even bigger companies buy it just because it has that better yield and has the maturity also. And they like that more. It's easier for them to decide on that versus putting Bitcoin on the balance sheet or putting something or doing something with Bitcoin directly, also with self-custody and all of those things. Is that maybe the more realistic way Bitcoin gets into like a mainstream adoption kind of a situation?
Yeah, I definitely think so. I mean, there's a couple points there. Like one, this like brings up the whole concept of like passive index funds and passive investing, where what a lot of capital is in passive index funds, but even not necessarily passive index funds, there's a lot of capital just simply benchmarked to various indexes. And from my perspective, a lot of capital really just goes out and chases returns. Like there aren't that many active investors that are like trying to pick certain things. And even if they are active investors and they're trying to pick certain things, they're typically picking the things that are working and they're just chasing what's been working. And passive capital by definition is just allocating capital however the market allocates capital. And if something is going up relative to everything else, then the passive market would then be reallocating capital towards that one thing that's working. So there's like a lot of reflexivity when it comes to that. And an example of it is Stretch in BlackRock's preferred equity ETF. I think it's like the number, since Stretch is the largest, perpetual preferred equity in the world. It is the largest or one of the largest assets within BlackRock's preferred equity ETF. And as they sell more Stretch, as the value of all the Stretch outstanding grows, then that asset within that ETF becomes a larger portion of that ETF. And then as more dollars continue flowing into this ETF, pretty much by design and just automatically by people adding to their 401ks and so on and so forth, more capital then flows into these things. And if so much capital around the world is effectively just chasing whatever is working, then once this like starts working and starts gaining momentum, and the fact that it's, you know, very, very scalable, and the fact that, you know, as it's working, Strategy and Strive are going to be issuing more of it. The same applies to Amplified Bitcoin. You know, MSTR, for example, is in the NASDAQ, it's in QQQ. And so as capital flows into QQQ, which is a very popular ETF in the US for people saving for the future and, you know, investing in technology, well, that capital flows into MSTR. MSTR, if it's trading at a premium, or even if they're just using it to pay their dividend, like they're issuing shares into the market, which may not necessarily do anything for the market cap, so to say, or for the price, so to say, but it would increase the market cap. Then that MSTR becomes a larger portion of that specific ETF. And then again, more capital starts flowing into MSTR, which then flows into Bitcoin. So yeah, I mean, I think like as these things get bigger and bigger, more capital is going to be chasing it. And as it has more liquidity and more volume, more capital will be comfortable saying like, oh, I can hold this today and then I can theoretically sell it, you know, tomorrow, and I can enter and exit in size. Like, you know, I think that maybe, I don't know, daily volume on SATA as like 30-day average might be like 38 million. Stretch, you know, it's probably like hundreds of millions, but it's not like billions quite yet. Whereas like if you look at probably something like SPY or VOO, which are like S&P 500 ETFs, and there's billions and billions and billions of dollars traded per day. And that's what gives, you know, investors the confidence to, you know, trade those, move in and out of those, and hold those as like a core portion of their portfolio. As liquidity and volume continues to grow, it enables people to have more confidence that, hey, like I can enter and exit these assets pretty quickly if I ever needed to, which is kind of interesting and obviously very useful.
This brings me to another point of the S&P 500 inclusion for strategy, which of course they have to do some things. I think they have to be profitable for the last quarter and the last 4 quarters combined or something. And the committee obviously can always decline. But how likely do you see that this will come into reality, and what kind of effect does it really has on strategy? How big of a deal would be a S&P 500 inclusion? With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today. And you can make with that unlimited amount of backups. Go now to microseed.io. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC-free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control. And I can sign up with Ocean. No account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together.
Yeah, I mean, I think it'd be a really big deal. I believe there's also like a Bloomberg 500 index, which, you know, the S&P 500, there's a committee There's certain rules that companies must, like you mentioned, like it has to be profitable in the last quarter, and I think maybe like the last 4 quarters combined. And the market cap needs to be a certain level, and possibly other rules that I can't remember off the top of my head. But and then there's still a committee at the end of the day that has to approve, like, okay, well, this company is in, this company is out, and there's not necessarily like a strict rubric as to what their criteria is. And obviously, kind of like we mentioned with digital credit, like these are very like unique, different companies compared to historic normal companies that like Apple or Microsoft or Walmart or Coca-Cola or whatever else. And so, there's no guarantee that strategy would get into the S&P 500 or would ever get in. But I think it would be a big deal if it does get in, and I think it probably eventually will. Like I mentioned, there's like something called like the Bloomberg 500 or something along those lines, and they don't have a committee and they don't have necessarily a strict rubric. I believe it's just the top 500 largest companies in the U.S. Those are the companies in the index, and by definition, it's pretty similar to the S&P 500, but it's not the same 500 companies. It's slightly different, but they're two benchmarks that trade pretty closely together. And if I believe strategy is included in this Bloomberg 500 index, and if they are, and strategy does well over time, and Bitcoin does well over time, which I believe will happen or has a good probability of happening, then the Bloomberg 500 index will be superior to the S&P 500 index. Like, people forget that there's a lot of different indexes, and they're all kind of competing with each other to provide the highest, the best risk-adjusted return, or to match whatever they're trying to show. And typically people want just high returns and high risk-adjusted returns. And so if you leave out one of the companies that happens to be one of the best performing companies in the world, that's going to be not necessarily great for your index. So yeah, I think eventually it will get included, and it's already included in various other things, like I mentioned, like QQQ, like Vanguard Total Stock Market Index, like that. Strive is in that, Strategy's in that, a lot of Bitcoin treasury companies are in that. And I think that just reiterates like my previous thought of passive. A lot of capital out there is just passive. It's just following returns. It's going to wherever the world allocates capital, and it's pretty like simple out there. And as more Bitcoin treasury companies or strategy gets added into these indexes, more capital is going to be chasing these companies. And because of the nature of these companies, the fact that they go out there and issue additional shares to buy Bitcoin to grow the business in an accretive manner, the fact that they're issuing shares makes them a larger portion of the index, which will just make this a very positive feedback loop for more and more capital flowing into Bitcoin. And like I said, I think most people in the world don't think about investing. Like they don't try to beat the market; they just are the market. And this is how Bitcoin begins infiltrating, like the Trojan horse of just naturally infiltrating everyone's portfolio without most people even realizing that they're buying Bitcoin.
Yeah, and I think people also don't realize this with the S&P 500 of like there's a process that it follows. Even huge companies, I just looked it up, even huge companies like Tesla took about half a year from them meeting all requirements to be actually included in the S&P 500. So it just, things take a long time. Good things take time, or like there's a saying in Austria, I don't know if there's like something similar in the English speaking world, but it's basically like just bad things grow fast. Only like wheat or something like grows really, really fast. Good things and very long sustainable things take some time for it to really get started. And I heard that comparison recently, I think from Chase it was, of comparing strategy and what they're trying to do to launching a rocket to SpaceX. They tried a lot of times to launch like rockets into the atmosphere, and they failed multiple times. I don't know how often they blew a rocket up, which was not successful. And now they are this huge company and extremely successful, and also on the public market now, which is a whole another fun thing, because now we have another Bitcoin treasury company, really, really big one, all of a sudden included in the world. But it takes some time to do something really big, and Bitcoin in itself is already huge, but like amplifying that and having a play into that, I think it's just requires some patience and some testing out of like what works best. I do feel like, to come back to the rockets, that both strategy and Strive has a very good chance to be the rocket.
Yeah, I agree. I mean, I don't think Strive will necessarily be the largest, Bitcoin treasury company in the world. I think Strive has that title, or Strategy has that title pretty clearly. I do think Strive could be the fastest growing Bitcoin treasury in the world. And, that's definitely what we're trying to do.
Really cool. Actually, I'm curious, because like if you look at it, Strive and Strategy are doing not the same thing, but like doing very similar things, and they're competing for very similar things, but they're extremely friendly to each other. Which, if you think about, I don't know, the thing of like Apple versus Microsoft, or Samsung versus Apple. Like, okay, Apple always seems to be included, but like there's many different companies that do want to have the same market or compete in the same market, and they have public beef even. Maybe it even is good for them for sales wise, because like beef always gets attention, as we saw in BIP 110, I guess. But like, is there, or let's, how do you see the relationship between Strive and Strategy? Like, why does it seem? It almost seems like it's the same company. Like, they're very friendly.
Yeah, I mean, I definitely think it's. I think it's like maybe a good word for it is co-opetition rather than like pure competition. It's similar to like playing golf with like one of my good friends or all of my friends, right? Like we go out there, we're friends, but at the end of the day, I want to beat my friend and my friends want to beat me. And that's competitive, but at the end of the day, like we're still friends. And I think part of the reason like Strive and Strategy are still friends is because of like the unique nature of this business. Our business is buying Bitcoin and holding it and creating, financial products on top of it, and effectively creating this amplified Bitcoin position, because we're huge, massive Bitcoin bulls, because we think it's, incredible form of money that is not adopted currently and is in the process of being adopted by the entire world. And if that is true, and if our thesis is correct, then we actually want every company, every individual, every government, anyone that holds any capital at all to be allocating towards Bitcoin. And if that happens over time, which I think it is happening and it will continue to happen, then we're going to win massively. And so that's, I think, where a lot of the friendly competition kind of comes from. It's that we want to accelerate Bitcoin adoption as fast as we possibly can. And you don't accelerate Bitcoin adoption by yelling at your neighbor when he bought more Bitcoin than you, or when he bought Bitcoin. You go out to your neighbor and you educate them, you offer them help, advice if they want it, and you show them, you show by example maybe a path of how you can do that. I think that's what Strategy has done for obviously like the hundreds of companies that have bought Bitcoin and put it on their balance sheet. And I think that's why Seyr and others in Strive are like very supportive of other businesses and corporations going out there and putting Bitcoin on their balance sheet, because I think it helps everybody at the end of the day, upgrading the world to a better, sounder form of money that creates better economic incentives that, over the long run could potentially like shrink the size of government, or put a better check and balance on the size of government. It could shrink the mega corporations, or it creates different incentives around empowering like local, smaller entrepreneurs, empowering the individual rather than large entities. And I think that that's like a world worth moving towards and accelerating towards, and encouraging other individuals around the world to embrace and work towards. So I think that that's probably why you see the friendly competition between Strive and Strategy.
I have another thesis, and it's because there is a common enemy. I feel like there's like the banks maybe in the incumbent system, and it's like you want to pull, like you kind of like, I don't know, like the two upcoming people that do something new, and there's like this huge world of TradFi in this fiat system that you kind of want to enter and like have almost a competition. I'm actually curious how you think about that, because I thought about, as I do with every investment, of what is the most likely situation in order for that investment to fail. Like every time I enter something, I was like, what must happen for that to completely like just like fall apart? And one fun thing that came up in my mind was, what if the banking industry, the TradFi world, the fiat world decides that Strategy and Strive is a threat to them and say, we don't want them, and try everything in their power to say that they have to go out. Like is there something, like we want them out, we don't want them to compete, we don't want them to give yield to people and have a stable base of like, that's our business, and we don't want to give them 13%, we want to give them 4%. Is there is that competition between Strategy and Bitcoin treasury companies and the incumbent system the bigger one? So it's like the two companies are so happy that they don't have to fight alone in this bigger fight?
Yeah, it's an interesting question. I don't know. I mean, like I don't necessarily see it that way. I could see how that, like, you could possibly think that. I mean, like you see something like right now, like the Clarity Act, like you have like large institutions like BlackRock, Fidelity, and others that are like coming out saying like the U.S. government should pass the Clarity Act, kind of embracing Bitcoin, embracing crypto, and kind of pushing innovation forward. And I think it's similar to like why a country would not necessarily want to ban Bitcoin. Like, you can't ban Bitcoin. If you ban Bitcoin, you can only ban yourself or your own citizens from accessing Bitcoin. You can't just make Bitcoin disappear. Similar to like a nuclear bomb. Like, yes, maybe the world would be better if no nuclear bombs existed, but they do exist. And so just because you don't build a nuclear bomb doesn't mean others are not going to build it. Like we're seeing this now with the AI race. It's like, okay, well, if we could create all these regulations in the US and make open source models like restricted and try to make them less powerful and have all of these like regulations and release models slowly over time. But if you do that, like China or other countries are just going to go out and build these models themselves, and their companies and their citizens are going to be using the better models and accelerating at a rapid pace, and we're going to fall behind. So you can't ban the world from new unique technologies. You can only ban yourself. And there might be like blockbuster like entities that see the writing on the wall and realize they are going to need to possibly pivot really quickly to stay relevant, and maybe they will try certain things. But at the end of the day, I think the superior technology tends to win, whether that's electricity, the internet, or Bitcoin. And I think Bitcoin is so vastly superior to all other monetary technologies that it's practically going to be very, very difficult, if not impossible, to stop. And I think that's I think treasury companies holding Bitcoin are kind of the same way, where there's no need to try to. There's not really much you can do about it. You might as well embrace the technology that is available and move on from there. So, I mean, yeah, I don't think that that's the case. Maybe that could change, but I think that are kind of like the the future is already here. It's just not evenly distributed. That's a famous quote from whichever technologist said that. But I think it's already here. It's just like you either choose to adopt it or you can't, and you can't really slow it down or try to stop it.
Yeah, I think so as well. Really, really well said. One big event I want to get into before we get to AI and other stuff maybe is the strategy selling Bitcoin. This was extremely, extremely interesting to see in the Bitcoin community because you kind of saw who's following strategies in the longer time and actually researching them, and who is not. And it felt like the people who haven't been studying strategy for the last couple of months and years were screaming the loudest in that at that event. How did you see strategies selling Bitcoin, why they did it, and what that meant for the evolution of digital credit?
Yeah, I mean, what's so funny about Strategy's business model is one, like if you look back from the moment that they started the Bitcoin treasury strategy in 2020, so six years ago, to today, they have outperformed Bitcoin, right? Like they've constructed this amplified Bitcoin position through various ways. My opinion, they've slowly improved how they've constructed it over time. First with convertible notes, as you mentioned, now with perpetual preferred equity, and so on and so forth, and then also like when the price is ripping and there's a lot of demand for amplified Bitcoin, their stock has a tendency to trade at a premium. And at that point, they can issue additional shares, buy more Bitcoin, increase Bitcoin per share that way as well, while still trying to maintain a certain degree of amplification or maintain the same amplification. So that's been like how strategies worked. It's outperformed Bitcoin. And with that model, they're naturally going to be buying a lot of Bitcoin at the top and possibly selling some at the bottom. In 2022, they did stack Bitcoin, but they also sold Bitcoin, right? Like they sold a little bit of Bitcoin in 2022. They actually, and as you pointed out, they sold a little bit of Bitcoin this year. Relative to their entire stack, they barely sold any Bitcoin, but they've sold Bitcoin. But that's like the nature of the model. It's like you construct this amplified Bitcoin position. As Bitcoin goes up, that means you're deleveraging if you don't buy more Bitcoin, because your dollar denominated obligations remain the same, but the Bitcoin on your balance sheet is growing as Bitcoin goes up. So when that happens, you need to issue more credit, buy more Bitcoin, and you keep doing that while it's going up. And once it stops going up, that's when, okay, well, if Bitcoin starts going down, you have all these dollar denominated obligations, which you can pay a variety of different ways. You can either issue stock and pay the dividend obligations if your stock is trading well, or if it's not, you can sell Bitcoin and pay the obligations. And at the end of the day, both are, losing Bitcoin per share. Whether you sell the stock or you sell Bitcoin, both lose Bitcoin per share within that transaction. Both are effectively pretty close to the same thing from like a fundamental economic perspective. And so that's kind of like just naturally what would happen. And it's funny because people are like, this guy is the worst trader of all time, yet like he's outperforming Bitcoin. And like, that's just how the model works. Like you get to amplify when Bitcoin's going up because that gives you the room to amplify. And when Bitcoin goes down, you have to pay the small amount of, the cost. You have to pay that cost of amplification. And you might have to do that by selling Bitcoin, but it's still small relative to how much more Bitcoin you can buy as Bitcoin simply goes up over the long run.
I thought that they sold Bitcoin, and I might be wrong, but they sold Bitcoin also mainly as addressing the credit rating. I think the S&P credit score that they got. I think they got like a B-, if I remember correctly. And one of the things that they wrote in there, and I tell that now from memory that I had like 6 months ago or something like that, that the Bitcoin that they have is basically worth nothing in their eyes, because they're saying they're never selling them, they're not using them and all of that. And if they sell them, they might, the Bitcoin price might completely crash down. And so they are not really able to sell that and monetize that asset. And so what I saw them also making was preparing the market for them to sell Bitcoin, so the market is not crashing. And I found it really smart that they talked about it for months already beforehand. Then they sold a little bit of Bitcoin, which is a laughable small amount, something, I think 32 it was. I still wanted to this day, why not 21? But maybe I have to ask him one day. And then, what was it, 2 weeks later, 3 weeks later, something like that, 3,000 Bitcoin. And on that day, I don't know how it happened, but on that day, he sold 3,000 Bitcoin, and Bitcoin actually went up on that day, which was crazy for me to see. And they proved now to the credit rating agencies to see, we have a bunch of Bitcoin. We have over 800,000 Bitcoin. We can just sell a little bit and raise a lot of money for them, even in the middle of a bear market, which I think is a great case for them to increase their credit rating. But I have no clue about credit rating agencies. So that's just my pleb view.
Yeah, no, I think that that's also like very accurate. I mean, I think a lot of people probably like in the Bitcoin space, at least from my perspective, like I was not surprised to see them be able to sell like $200 to $300 million worth of Bitcoin over a week. I mean, you could do that like extremely fast if you wanted to. I mean, I think like looking back the other day, this may have been like a month or two ago, but there was one trade on IBIT, which is BlackRock Bitcoin ETF, where someone unloaded like over $1 billion worth of Bitcoin in one single trade. So like the Bitcoin market is way more liquid than probably like outsiders actually expect on a short time horizon. Like you can move in and out of Bitcoin in like a ton of size, like very rapidly, really without impacting the price much at all on a short time horizon. And I think that that's like, yeah, I mean, that's probably helpful for the rating agencies to obviously understand that, okay, like strategy holds 50 billion or 60 billion or whatever it is of Bitcoin, and they can sell hundreds of millions of it. They can sell billions of it. And like, the price might go up after they do that, as you pointed out. So yeah, I mean, I think that that's like helpful to show that strategy is not the entire Bitcoin market. They're still like a small fraction of the Bitcoin market. And I think that that's like pretty important once you're to understand that like this Bitcoin is not strategy and strategy is not Bitcoin. Like they're separate things. And maybe a lot of people don't necessarily understand that.
Yeah, I think the biggest strategy haters are the ones that don't hold the stock, but whole different topic. That just came in my mind. Why did I mean, that might be a weird question for you to answer, but why did Strive not sell Bitcoin so far? Is it like the need didn't come up? It was just not something that you didn't have to do that? Is it something you're kind of like thinking about? Also trying to educate their own shareholders on like potentially selling Bitcoin down the road?
Yeah. Well, from the beginning of Strive, like even before because I was a part of Similar, before I joined Strive, Matt Cole and the Strive executive team had been pretty clear that they were very similar to strategy, but there were a few differences that were important differences between Strive and strategy. One was Strive started with a US dollar reserve when they did the reverse merger into ASST. So that was like strategy didn't have that at that point. Two, Strive said that they'd be willing to sell Bitcoin to honor the dividend obligations if that ever needed to. Like they were very, open to saying that they could sell the Bitcoin if they ever needed to. And then three, like Strive, has no debt, right? Like that's very different from strategy as well. So like those are like three big differences between Strive and strategy. And I think that maybe honestly, like being transparent about that from the start, and saying that like in the case of paying the dividend obligations, we can sell Bitcoin to make the dividend payment. I think that's probably maybe the reason why one reason why SETA has traded relatively well relative to Stretch. Obviously, having the USD dividend reserve is another thing, and having no debt is another thing that probably helped. But yeah, no, I think that's we have definitely in the past said that we'd be open to selling Bitcoin to fund dividend obligations, like if that ever if it ever needed to. But when it's accretive to raise capital and buy more Bitcoin, or when it's accretive to raise capital and fund the dividend obligations that way, we're most likely going to choose that rather than start to unload some of our Bitcoin, or a small amount of our Bitcoin.
It's interesting because you brought up Seyr, which is the product of Strive, if people are confused, and has traded significantly above what Stretch is trading at pretty much since Strive announced daily dividends. I think that was pretty much the breaking point where all of a sudden Strive was trading higher than Stretch, which was interesting because Strive always paid up the higher yield. They had the US dollar cash reserve before. Now, of course, Strategy also has that. Is the daily dividend the thing that makes it so much more compelling, or is there other reasons that you think it might also why they trade so differently right now?
Yeah, I think that's definitely one of them. I think the consistency on the US dollar reserve is another, kind of like we talked about, like Strategy. We had it first. Strategy then created one. Then they used it to pay off a convertible note. Then they slowly built it back up again. So like there's been like just like inconsistency, I guess, with it, where Strive has kind of had it the whole time, obviously. And then the other thing is probably just the idea that Strategy is a much larger company. It's been a public company forever. And Seyr is an incredible spokesperson. He's an incredible marketer for Bitcoin. A lot of people know who Michael Seyr is, and people saw STRC trading at 100 and understood like Michael Saylor's brand and the Strategy brand, which is an incredible brand. And maybe there was more, I guess, like intuition that product would be more stable than SATA, SATA. And therefore, because the market thought that invited more people to borrow against it, use it as collateral for leverage, open up margin loans against it. And so the perceived stability created fragility due to the leverage that the stability invited into the market. And if that, leverage was and margin calls and so on and so forth was a key reason why the drawdown really even occurred to begin with, I think that could be another reason why. And so yeah, I mean, like there was, a variety of different reasons why, certain things trade the way that they do, but I think those are some of the key ones.
That's interesting. I've because we're closely coming to the end of the time, I have one question that it's been discussed so much on podcasts and on Twitter, is the BIP 110 thing. I just want to get your take on it, of like, why do you think it is such a big topic, and what do you think BIP 110 in general is like? Why do you think it's such a huge topic right now?
Yeah, it's interesting. I mean, why it's a huge topic. I don't know. There's that meme that's been passed around a little bit of, Bitcoin peaked in October of last year, and Bitcoin Core version 30 was released around that time. And some people have suggested that, oh, well, that's why Bitcoin peaked. It's because, Bitcoin Core changed a default in the mempool policy for new nodes that download the most recent Bitcoin software, and they increased the configurable number that enables certain op return transactions to be passed around in various nodes mempool, and that got blamed a little bit for like the bear market. And when bear markets in Bitcoin occur, people are bored and they are trying to like pinpoint exactly what's wrong. For example, this bear market has been a little bit unique in that like stocks have done pretty well this year. Bitcoin's down it was down like 50% from its all-time high, whereas like a few months ago, like stocks were at all-time high. I mean, it's still the S&P 500 is pretty much, it's not an all-time high right now, but it's pretty close to it. Whereas the other historical Bitcoin bear markets have bottomed near where the S&P and NASDAQ are down like significantly. And so like people are trying to figure out like, well, why is Bitcoin down so much when liquidity is fine, traditional markets are fine. And so maybe people are kind of like using this as like a scapegoat on, like why Bitcoin might be down. Personally, I don't buy into that like at all. I think I saw like Matt Hogan, who works at Bitwise, he's spoken to like 15. I saw a tweet. It was like he's spoken to 15,000 institutional investors, and not a single one of them has asked him about BIP 110. So I think a lot of people, allocating a lot of capital in Bitcoin and moving capital, like really are not thinking about BIP 110 at all. I think even people that like support BIP 110, I don't think that they've sold a lot of their Bitcoin because of what's happening, so to speak. I think like it's almost had probably like no market impact. If anything, it's like confused people in the short term as to like, outsider, like, what the heck are you guys arguing about here? But at the end of the day, I think like it was kind of a misunderstanding from the start. I think at this point, it's pretty clear that the proposal would not stop spam like at all. Maybe in certain aspects that it does today, but it's been demonstrated by a number of different people that you can still embed PDFs and MP3s and all sorts of different files of significant size in BIP 110 compliant transactions. And so it's at the end of the day, now it's like, why would we want to change the consensus rules of Bitcoin to solve a non-problem problem? And we wouldn't even solve the problem by doing this. And I think that's why, that most people at this stage and don't support BIP 110. I think it's why like miner signaling is like 1%, because no one, it's not as popular as some people may think it is. And I think we like Bitcoin has had bugs. Bitcoin probably has bugs today that we're not even aware of. There's other future threats like quantum, and other things that Bitcoin will need to face, and maintenance will need to be done over time. And I think that like that's a better thing to focus on potential future Bitcoin threats. Focus on like trying to identify any potential bugs that exist in the software today, and try to fix those bugs before they possibly get exploited, rather than trying to prevent a little bit of spam on the blockchain when the block size limit and the fee market already do a good job of preventing a certain amount of data from being embedded in the blockchain.
Yeah, I think it's hard to argue that there is a spam problem when you can send $1,000 over the Bitcoin chain for like 70 cents. So it's like the fees are very low. It's just interesting to see the uproar and the emotional trauma. For me as a podcaster, I always love some trauma. But I agree with you 100%. We have an end routine, as you might know from previous appearances, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you a very simple question, I think, and a very quick one. Do you think Bitcoin is money for your enemy?
Yes. Bitcoin's money for everybody. It's permissionless money. No one can stop you from holding it. Even if you don't like your enemy and you don't want them to hold Bitcoin, they can hold Bitcoin. You can't prevent them from doing so. So absolutely.
I think that's the easiest questions in the 800 episode sequence that we ever got. Thank you so much, Joe, for being on the podcast. Before I let you go, where can people find more about Strive, Summer Scientific, and you personally?
Yeah, thanks, Robin, for having me. Enjoyed the conversation. Always like talking about Bitcoin. You can learn more about Strive at strive.com. You can learn more about me on X or YouTube. Probably just type in Joe Burnett or Joe Burnett Bitcoin and should pop up. But thanks for having me on. Enjoyed it.
Awesome. Thank you so much, Joe, for being on the podcast. Also, thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.